Hello, everyone. Welcome to Money Hour Radio, a show where we try to help you grow your money, pay less taxes, and have a beautiful retirement. What could be better than that? I am one of your co-hosts, Ben Barzideh. I have my co-host here, Matt Nadeau.
Hey, everybody.
We are both founding partners and wealth managers at Barzideh and Nadeau Wealth Management, a comprehensive financial planning firm located right here locally in Barrington and serving the greater Chicagoland area. And of course, our fiduciary obligation to put our clients' interests first is the tenet of our company philosophy. And as an independent firm, we truly have the freedom to focus solely on you and not some corporation.
Yeah, and as always, we want to just take a moment. We know there's clients that faithfully listen to us every week, and thank you so much for listening. Even those who aren't clients, thank you. But for our clients, we want to say hi to them. We appreciate the trust you've placed in us, and we love every one of you. And we have a great show, Ben. This is going to be a very special show. Later, our next segment, we actually have a special guest, Steve Peck. We're going to do an interview with him. He's an estate planning attorney. We've used him for many of our clients, so that should be interesting. But before we dive into that, our first segment, we love to talk about what's happening in the markets, the economy this week. Obviously, China, the trade war, it's always some angst with that. The good news, though, some good earnings. And then we're going to, of course, talk about some Fed news. And then we're going to dive into something with some credit issues, some potential liquidity issues, and AI circular financing agreements. What's that, Ben?
It's going to be so interesting. I can't wait. But before we start, we encourage you to follow us online at our BN Wealth social media pages on Facebook and Instagram. Don't forget to subscribe to our weekly economic newsletter that's called the 5-Minute Market Brief. It's informative, it's succinct, and easy to read. You can sign up on it on bnwealth.com. And then lastly, please subscribe to our YouTube channel on moneyhourradio.com, where you can view this week's episode along with previous ones.
Yeah, do us a favor. Go subscribe. That helps us out. So
No doubt.
Anyway, let's jump in. So obviously, we got to talk about this China trade war angst, and it's resurfacing. And if we flash back to Friday a week ago, I mean, markets were definitely rattled when President Trump, threw out that, hey, we're going to just hit China with another 100% tariffs, citing their sinister activity involving rare earth metals. And that did catch people by surprise. And it led markets to pretty much the worst day it's had since April.
No doubt.
And since then, of course, tempers have cooled, negotiations continue, but it's just a reminder that there are trade risks and they have not gone away yet.
No doubt. All right, let's look at earnings. Really good week of earnings. Major U.S. banks reported mostly upbeat quarterly results, and critically, they didn't sound any alarm bells about credit risks or signs of weakening consumer spending, well, at least as of yet. However, the Fed, well, they didn't sound as positive. So our favorite Fed chief, not so favorite one here, Jerome Powell, a.k.a. J-Pow, he gave a speech Tuesday to the National Association of Business Economists. And of course, as usual, he had nothing positive to say. Seems like every time that guy talks, the market tanks.
All right, it wasn't that bad this time. But he did make some important notes, right? He noted that there are inflation pressures from tariffs and significant downside risks in the labor market. And he said there are signs that liquidity conditions are gradually tightening, which for anyone who went through the financial crisis starting back in 2007, the term tightening liquidity should immediately trigger some PTSD, because I think we remember how that ended, right? Not too well. So also the September meeting minutes from last week confirmed that most Fed members are viewing that employment weakness is a greater concern than inflation. So, other than that, everything was fine, right, J-Pow?
All right. So what are circular financing agreements? And over the past few weeks, we've mentioned that on our show, the recent explosion of circular financing arrangements with tech companies involved in AI. And while it's not unheard of, it's definitely not common for companies to give their customers money to buy their products. But that's exactly what's happening currently in the AI frontier. And vendor financing is commonly used in the auto industry and other manufacturing businesses where the vendor will loan distributor money to buy a product and then is repaid when that product is sold by the distributor. also reminiscent of Lucent Technologies in the late 1990s tech bubble.
Yeah, so this isn't unheard of, but it's a little weird. And the announcement of several deals we've seen between semiconductor companies and AI companies raised the question about, is there really a bunch of demand for AI technology? And how much is there if there's just this intermingling going on? So let's look at a few reference points here, because just over the past few weeks, there's been 3 deals specifically that have raised a few eyebrows. So NVIDIA, right? They agreed to invest $100 billion in OpenAI so that OpenAI can turn around and buy NVIDIA's chips and processors right back from them. Now, on the flip side, OpenAI then agreed to purchase an undisclosed amount of AMD, and in return, the company AMD is giving OpenAI warrants that could then give the customer a 10% stake in the company. Another big deal. And then a third one, XAI, announced it's raising $20 billion with backing again from NVIDIA, and a separate entity is going to be created with the chip maker, NVIDIA, renting out its processors to XAI.
They're basically passing money around to each other, right?
It's just like this, yeah. And hey, as long as it makes the numbers look good, I guess they'll keep rolling with it.
Now, here's the thing. But beyond the near term, this risk cannot be dismissed. And all of this investment in AI better pay off. And unfortunately, that's why a recent article from The Information, it was a little spooky. They said that Oracle is actually losing money on renting NVIDIA chips, and its margins in the cloud business are much smaller than expected. And that's adding weight to the arguments we've been hearing about AI not being able to deliver on its future profits, and thus maybe reinforcing the AI bubble concerns. But bottom line, massive bets have been made that AI is going to be the next iteration of the internet. And like the internet, AI will become an indispensable part of every business and a person's life.
Yeah, and this is the danger with this, is that what if we go back to like how the initial internet boom was, where regular people's adoption of it, or some businesses' adoption of this, doesn't just happen immediately, but it takes years to happen. And at some point, if that promise of return isn't there, then the capital expenditure that we're seeing will dry up, and then tech could be the leader, not on the way up, but on a bad market crash on the way down. And if it sounds familiar to some of us who are a little older, it should. This is what happened in the dot-com bubble. And Ben, one of the other things with AI, there's a lot of maybe retirees or people out there who think they're safe investors that are buying like real estate investment trusts that pay off these dividends, REITs. Go look at your REITs. What are they buying right now to get these returns? Are these massive data centers that are being run because of AI. You'll be shocked to see how even something that would be considered a dividend-paying safe REIT are also falling into this trap with AI because they're buying up these massive data centers. So it's not just one industry. It's all over the place.
So here's the good news. For right now, it's not a today problem. There's a lot of enthusiasm in AI. We're very bullish. In fact, in a lot of our more growth-oriented models, we are heavily invested in the market. But we're watching it because if things change, our philosophy is we don't believe in riding a potential market crash all the way down to the bottom. And we will actually sell out if we have to protect our clients' portfolios. So if our investment philosophy resonates with you and you're looking to have your money managed like that, then please reach out to us and schedule a complimentary consultation. We'll go over your current financial situation and your goals. If we can help you, great. If not, that's okay too. We'll still part as friends. And speaking of that, next week, we're going to have our very first high-end Barzideh wine tasting workshop. It's a venue where you can come see us. We're going to have a short presentation on how we can help you. We're going to drink some good wine from the Prisoner family. It's from 6 to 7:30 on the 23rd of October. You can go online and register for that or give us a call at 847-780-2980. And don't go away because when we come back, we're going to have an interview with Steven Peck. You don't want to miss it.
Welcome back. Thank you for tuning in. This is the Money Hour Radio, where we try to help you grow your money, pay less taxes, and have a beautiful retirement. And I'm one of the hosts, Matt Nadeau. I, of course, have my co-host, Ben Barzideh, with me.
Hello, everyone.
And we also have a guest today. But before we get into him, for you listening, I'm sure many of you are going to eventually leave like your IRA to your heirs, especially if it's a large IRA. And this is a very important segment to pay attention to. So what you hear today may actually help save your inheritance from going to creditors or ex-spouses of your kids, and frankly, maybe even protect your kids from themselves. So it's a way to make sure your legacy is not squandered, and it can also help your kids from possible estate taxes when they pass that money maybe on to your grandkids. So it's very powerful.
No doubt. So we have the honor of hosting our distinguished guest today, Steven Peck, from the law offices of Steven H. Peck in Riverwoods, Illinois. And he is hands down one of the best and most knowledgeable estate planning attorneys that we know in all of greater Chicagoland area. He has 32 years of experience. He's done several hundred estate planning seminars over the years. He's also co-written 2 books on estate planning as well. And lastly, he also went to Harvard, which is pretty impressive. And as some of you may know, I actually went to University of Colorado at Boulder, which is also considered by some as the Harvard of the West.
You mean the Harvard, Illinois of the West?
Yeah, no. But all kidding aside, he's great. We've sent a lot of our clients to him for work over the years. And actually, Steve also does our own personal estate plan. So we eat our own cooking here when we say we value his expertise. But before I start, I just want to say hi, Steve. Welcome to our show. How are you today?
I'm good. Thanks, guys.
Fantastic. Can you please share with our listening audience just a little bit about you, your company, what type of legal work you help clients with?
Okay. Well, I totally concentrate in estate planning and elder law care planning. Also, I don't do any other kind of law because there's too many different things to be a jack of all trades. So this is what I've concentrated in for the past 32 years. So I primarily help people by creating different kinds of trusts, whether they're revocable living trust or what we're going to talk about today, the Standalone Retirement Trust. I have, can handle people with insurance trusts, gifting trusts when they had too much estate value that they don't want to have their kids pay higher estate taxes, because Illinois has like the 3rd lowest threshold for estate taxes in the country. I guess we're not number 1 in that, but we're still number 3, so we have to worry about it. Most states, you don't have to worry about state taxes at all. There's only a $4 million exemption here instead of the $15 million federal.
For sure. And it's important, to be an expert in a specific area, especially one this important, because we're talking about, for a lot of people, it's a lot of money. We always have a joke: a small mistake on a small amount of money is a small amount of money. But a small mistake on a large amount of money is a large amount of money. And that's why you need an expert like Steve. So he's going to be discussing with us a lot of this important stuff today.
And Steve, so today we want to talk about a very important estate planning tool called a Standalone Retirement Trust. And by the way, Steve was way ahead of his time, as he was talking about this over a decade ago, way before we heard it from other attorneys. But can you please explain what a Standalone Retirement Trust is, Steve?
Okay, well, the reason for that is now that we have the Secure Act, so that beneficiaries only have 10 years with a couple of exceptions to take out their money and pay all the income tax. And so what most people do is, whether they have any kind of estate plan or not, is the financial advisors will say, just name your kids as the beneficiaries directly, and then it'll be an inherited IRA. When you had 30 years or whatever to spend over the life expectancy under the old law, that wasn't too drastic. But if you have $1 million IRA, to clean it out in 10 years, you got to take out like about $150,000 to $200,000 per year to zero it out, with the rest of the money being tax deferred. And so at the end of 10 years, even after paying income taxes, there still could be $1 million left in the account. And now the children have it directly in their own name, unprotected from a trust. And so what happens is in Illinois, for instance, your own retirement account, whether it's an IRA or a 401k plan, is completely protected from creditors. But the Supreme Court ruled a number of years ago that inherited IRAs don't have that same protection. It's just another inheritance. So if you leave your kid $1 million in your retirement account, and the kid gets sued from a car accident, divorces, job liabilities, or whatever, it wouldn't be protected. And one of the things I do with my trust is I make sure that even the regular assets are kept in trust permanently, and the kids just take it out as they need it. They can invest it in anything they want, the same investments, but it is, protected because it's still in the parents' trust. So if you inherit it in a trust, and since the law's only been in effect for 5 years, nobody really knows how the IRS is going to look at this stuff 5 more years from now. If, all the money has to be just totally liquidated in lump sum, whatever's left in there, if they didn't, use it for distributions. But this trust has the IRS's blessing, basically, that if it's in this kind of trust, at the end of the 10 years, the balance, because if you take out the money for income tax purposes, and I put in a income tax clause that if the trust is in a higher tax bracket, the kids can use their own tax brackets to pay the income tax liability. But at the end of the 10 years, there's probably going to be, if they don't spend it and they just got a 5% rate of return, even if they're paying 25% tax, there's still going to be about 25% growth in the money. If you had a Roth where you don't have to touch the money at all for the whole 10 years, the money would grow 70%. So even if you say they got $1.25 million on $1 million original inheritance, now that's completely protected for them. And they don't have to worry if they have any kind of liabilities, that the money is fully protected. And then basically at the end of the 10 years, because now they're paying, the money as it comes out goes into a taxable side account. And that money would be, you can put it into capital gains type tax advantage investments that you guys would, be able to, steer your clients to get them the best return. At the end of the 10 years, since now everything is going to be taxed as ordinary investment income, you can merge that with their living trust, and they only have one set of trusts to worry about. And now it's, fully protected for the rest of the kids' lives. And, my tagline is I protect people's inheritance from creditors, predators, and the IRS.
Well,
Wait.
on that point, Steve, actually, we did a show a few weeks ago about inherited IRAs, and we talked about how that's generally an election that your heirs make once you pass. And it's up to them to know how it works and to do it. But I joked about how if you want to force your kids to do the right thing, the responsible thing, kind of have control from the grave, that there are certain trusts that you can utilize for that. And this is certainly one of those.
Well, I don't say rule from the grave. I say protect from the grave.
Exactly. There we go.
Because that's what they're effectively doing. I mean, even if you people say, I trust my kids. I said, I don't care if you trust your kids. Anyone could get into a car accident. Doesn't matter if you have a PhD or a high school dropout. They say one out of every 3 people is usually a defendant in a lawsuit sometime in their lifetime. So it's a very, very high percentage there you can be at risk. And half of marriages end in divorce. So you want to protect against the in-laws, or as I call them, the business, the outlaws.
Well, and you hit on a good point there, because control is one of the big features there, like you said, protection. So just using something like this also adds that layer of control for the kids to protect them from themselves, right? Like if, your kids are great and you're worried about lawsuits, but what about those kids out there who are spendthrifts and may blow through it all and not get these tax advantages?
No doubt.
You got it on both ends, because if you have spendthrift kids or just totally irresponsible kids, you want somebody else to manage the money for them. It covers that. But if you have totally responsible kids, I said the kids can be the trustees of their own shares. If they need to have a second trustee in there for creditor protection, they can appoint an independent third party, which means, they're, you're going to have the ability to say, oh, I can't take the money out of the trust on my own volition because I got to get a third party and the judge doesn't have jurisdiction over this third party, but otherwise they can do whatever they want and invest it any way they want over their lifetime. And it's part of the parent's estate still. So if they die and it's within the tax limit, even if it multiplied tenfold during the kid's lifetime, it doesn't really matter because now it's exempt from taxes when the kids go, going to the grandchildren. That's how we create what we call dynasty trust.
No doubt.
And
Steve, we have about maybe a minute and a half left. Did you want to tell our listening audience your contact information, the best way to get a hold of you?
All right. Well, I have a website, which is Peck Trust, my last name and the word trust.com. You can email me at Steven with a V at pecktrust.com. My phone number here is 847-940-0607. But if you want to remember it, I have an 800 number and it's 800-I-TRUST-YOU. Okay.
That's a good one. I like that.
Great. 800 I Trust You. Absolutely. And we'll put your contact information on our podcast link so people will be able to reference it. But we are running out of time. Again, we're going to just wrap up real quick. Thanks, Steve. But we do have our first high-end Bordeaux wine tasting coming up October 23rd from 6 to 7:30. Please go to our website, moneyhourradio.com. You can sign up for that. You can get information on Steven Peck. Thanks, Steve. We really appreciate everything, and we'll see you all next week.